students. Welcome to the lecture on Introduction to Financial Planning. And after the lecture, we will be able to learn the following objectives. Explain the concept of financial planning. Describe the financial planning process. Discuss the steps of the financial planning process. Explain the importance of financial planning. Define the long-term financial planning for businesses. Understand development and implementation of a financial plan. Let's start with a brief introduction of financial planning. A financial plan helps one to fulfill financial goals and meet personal and professional priorities. It takes into consideration the available resources, responsibilities, lifestyle, and risk appetite. The purpose of financial planning is to help one make the most of the financial resources by setting realistic goals and finding a way to reach them. Planning and budgeting is responsible for developing and linking the strategy of a business and its major units to its long-range and annual operating and capital budgets. Planning and budgeting is also responsible for developing resources who are skilled analytically and who have a deep understanding of needs and interests.
So when it comes to financial planning, the question would be, well, what exactly is a financial plan? So a financial plan, first of all, is a roadmap to help you get to where you need to be. Part of determining where you need to be is to sit down and really consider, well, what are my goals? Because certainly if you don't know where you're going, any road will get you there. What we like to do is really assess your situation. So in terms of your financial plan, what we need to do is gather information, evaluate the current situation, and then make recommendations to help you get where you want to be. Some of the key considerations folks would have at this stage might be, well, I have all this debt, so maybe that's all I should focus on. However, there are other things to consider. One being, what's the long-term objective? Paying off debt is certainly important. However, there are other considerations to bring into play to help you reach that goal, such as, should I start investing? Certainly as a resident, investing is extremely important. As a physician going forward, chances are you won't have a pension plan that will be paid for or looked after. You need to do this yourself. So part of the consideration is, well, do I start investing before I pay off the debt? Or should I look at paying off all the debt first and then investing? One of the key considerations there would be taxes. Nobody really likes to talk about that a whole lot at this stage, but what you're going to find is that's going to be one of your biggest liabilities, even bigger than the debt you're looking at right now. So if you don't acknowledge these other aspects of your financial plan and only focus on paying off debt, you might regret that decision down the road. So putting a financial plan together in cooperation with your financial advisor involves some steps. One of the most important ones will be gathering some information about you and your financial situation. That will help the advisor evaluate your situation to make specific recommendations to therefore put the plan into place. Once the plan is put in place, it's very important to continue with monitoring that plan and also making changes as the situation changes both for you and the environment when it comes to the financial planning industry itself. A comprehensive and solid financial plan will include various components. One thing that's very important, and maybe you don't think about when you're looking at your money, is insurance. Risk management is very important to analyze as part of a financial plan. So that means insurance, such as disability insurance, property insurance, life insurance. Sometimes perhaps critical illness may even be something that's important to consider at this point in your career. When you're looking at investing, RSPs, tax-free savings accounts, non-registered investments, RESPs for your children, and even corporate investing all make up a solid financial plan. In terms of this, you really need to look at what are the strategies. Sometimes there isn't just one. Maybe in your particular case, some options might be needed to be able to make the best assessment and decision for your own situation. Your financial plan will include things such as savings, investing, debt management, tax considerations, insurance, and a solid plan for the repayment of the debt in balance with other things such as investing, and again, that critical piece, tax planning.
Let's talk about the concept of financial planning. Financial planning is a process performed by professionals with training and expertise. Financial planners span compensation models, backgrounds, and specializations. The Securities and Exchange Commission, SEC, defines financial planning by outcome. Financial planning can help assess every aspect of the financial life, including savings, investments, insurance, taxes, retirement, and estate planning. Steps of financial planning. Financial planning is a gradual process planned by a company or a family to save money, which can be reserved for future use. It can be done by any entity that has a regular or irregular income, like a person, family, or company, etc. Financial planning in a business is very essential as the input and output of a business is totally dependent on the money available. It comprises three principal steps, like estimating and forecasting, preparing a budget, and controlling the outflow of finances. Estimating and forecasting. Short-run planning should include the company's customer base, goodwill, expenditure patterns, and possibilities in the near future, and other factors which affect the income and expenses. Long-run planning is generally a difficult task as one might not know about the success and failure of the company in the time to come. Preparing a budget. The capital budget gives a brief and rough understanding of the anticipated expenditure for fixed and capital assets, which are essential to operate a business. The cash flow budget ought to be based on the estimated cash flow to predict financial gain and expand it suitably as it is received. The operating budget normally prognosticates expenditures and gains. Controlling the outflow of finances. Financial control is very essential to ensure that the expenditure is not more than expected and to lower the possibilities for errors and employee larceny. Financial planning may sound intimidating and obligatory needs to be performed by a financial planner. Financial planning is an activity that certainly cannot be ignored by businesses, as the success and failure of the business is entirely calculated considering the pecuniary factors. Financial Planning Action Plan. The Financial Planning Action Plan should include all of the tasks that one will need to accomplish in order to improve the financial situation. Recommended action. The action plan is a list of all of the recommendations that one should accomplish in order to strengthen the financial plan. Purpose of accomplishing goal. The Financial Planning Action Plan should include a description of what the recommended action accomplishes. This helps communicate the importance of accomplishing the recommendation and provides an audit trail of sorts. Target date. All great goals and objectives are time-driven. This means choosing a reasonable amount of time in which to implement the recommendation. This is the easiest way to keep everyone on track. Finding professionals and specialists. When implementing a financial plan, one will probably need to rely on the expertise of a few specialists. Certified public accountant, A certified public accountant, CPA, can help with the preparation of financial statement and budgets. Insurance and brokerage services. As part of the Financial Planning Action Plan, one may need to open a brokerage account and request a consultation from an insurance professional. Estate planning lawyers. Estate planning is predominantly based in law and property rights. Finding a good lawyer will help one navigate the complexities of the law and help determine the best services for the situation. Here, we will discuss about the financial planning process. The financial planning process helps one systematically plan the financial future, such that long-term goals and dreams can be achieved. Long-term goals include buying a house, children's education, retirement policies, etc. Financial planning consists of 6 fundamental components. 1. Financial management. 2. Tax planning. 3. Asset management. 4. Risk management. 5. Retirement planning. And 6. Estate planning. Now, we shall understand the steps of the financial planning process. Establishing and defining the client-planner relationship. The first step in the financial planning process is to establish and define the advisor-client relationship. This normally begins at the first client meeting, although it can start prior to this meeting through telephone interactions or other contacts with the client. The first client meeting is essential for establishing the framework for a successful advisor-client relationship. Gathering information necessary to fulfill the engagement. Financial goal. After one has established and defined the advisor-client relationship, one is ready to move to the second domain in the financial planning process. A competent financial planner must be able to help their client sort through their goals and develop a clear sense of priorities. Financial risk tolerance. One piece of information worthy of special attention is the client's financial risk tolerance. One must determine the client's attitude toward risk before making the recommendations, preferably with the help of a scientific risk tolerance questionnaire developed by a third party. Fact Finder Form. Effective gathering of client information requires a systematic approach to the task. One common way to systematize the gathering of information is using a structured fact finder form. Most fact finders are designed for specific financial planning software to simplify data entry. Gathering information typically requires counseling, advising, and listening during face-to-face meetings with the client or clients. Gather data. 1. Summary of assets. 2. Summary of liabilities. 3. Summary of income and expenses. 4. Estate planning documents. 5. Education plan and resources. 6. Retirement plan information. 7. Employee benefits. 8. Government benefits. 9. Special circumstances. 10. Tax documents. 11. Investment statements. 12. Insurance policies and documents. 13. Closely held business documents. 14. Inheritances, windfalls, and other recognize the need for additional information. Analyzing and evaluating the client's current financial status. Once the client's goals have been determined and data has been gathered, organized, and checked for accuracy, consistency, and completeness, the next task is to analyze and evaluate the data to determine the client's present financial status. Thorough analysis may reveal certain strengths in the client's present position relative to those goals. Sometimes the analysis of a client's financial position will disclose a number of weaknesses or conditions that are hindering achievement of the client's goals. Let's now take a look on the importance of financial planning. Financial planning is a process which presents before an individual, organization, or even a country the current financial position and the adjustments in the spending pattern in order to meet the goals. The following points explain why financial planning is important. Cash flow. The cash flow is increased by undertaking measures such as tax planning, prudent spending, and careful budgeting. Capital. A strong capital base can be built with the help of efficient financial planning. Thus, one can think about investments and thereby improve his or her financial position. Income. It is possible to manage income effectively through planning. Managing income helps in segregating it into tax payments, other monthly expenditures, and savings. Investment. A proper financial plan that considers the income and expenditure of a person helps in choosing the right investment policy. It enables the person to reach the set of goals. Financial understanding. The financial planning process helps gain an understanding about the current financial position. Adjustments in an investment plan or evaluating a retirement scheme becomes easy for an individual with financial understanding. Assets. Many assets come with liabilities attached. Thus, it becomes important to determine the true value of an asset. The knowledge of settling or canceling the liabilities comes with the understanding of our finances. Savings. It is good to have investments with high liquidity. These investments, owing to their liquidity, can be utilized in times of emergency and for educational purposes. Here, we will discuss about long-term financial planning for businesses. Financial planning in itself does not involve just setting budgets, wage rates, or deadlines. It is all about getting to know a realistic work schedule, the manner in which they can be executed, backup plans that can be used, and the least cost with the help of which the entire project can be executed. Steps in long-term financial planning. Step 1. Let us take the example of a coffee shop where a financial planner has to find legitimate answers to 4 questions. Namely, 1. Why should one produce a specific item on the menu card? 2. When should one produce such an item and for what time duration? 3. Where should one produce the item? Right in the shop or some production center? And 4. How should one produce the item manually or mechanically? Step 2. The second step is to assess the business environment. In this step, Surveying the competitor's performance, pricing, and distribution is an absolute necessity. In such a scenario, one may also prepare a cost sheet of the financial features of production, namely, the money that one would have to invest as a manufacturing cost, its sales cost, and the profit that it would yield. Step 3. The third step is allocation of resources in such a manner that one tends to make a genuine profit in sales during the long run. In this step, one will be using and analyzing cash flow statements on almost a daily basis. Step 4. This step is quite an advanced one and typically includes many different aspects that aim at retaining the customers. The most important function of this step is to generate regular data and cash flow statements. With the help of these statements, one will realize whether that very item on the menu is proving to be profitable or not. Duties of a financial planner. A financial planner is a professional who helps a person deal with his or her financial issues. A financial planner helps a person in areas such as personal financial planning, investment planning, risk management, and insurance, as also his or her cash flow management. A financial planner guides an individual to take his or her major financial decisions. He or she helps the individual understand the consequences of each of his or her financial decisions. Job description of a financial planner. A financial planner studies the different aspects of the financial picture of his or her client and provides a suitable financial solution. The job of a financial planner can be described by means of a 6-step process given by the ISO. The first step is of setting financial goals with the client. The second step includes the gathering of relevant financial information from the client. The third step is of analyzing the gathered information, which is followed by the creation of a financial plan. The last 2 steps include tasks such as implementing the plan's strategies and monitoring the implementation of the plan. Financial planning ideas. Saving is one of the most important steps to ensure a prosperous future, especially when one carries out financial planning for the future. Learning to plan a budget for daily, day-to-day expenses is a key to financial planning for the future. One must try to balance between the income and expenses every month so that one saves a certain amount. Insuring important assets is also an important aspect of financial planning. Health insurance and car insurance are some of the must-have insurances for greater security in the future. Now, we shall understand the development and implementation of a financial plan. Implementation planning is the process of determining how an initiative will be implemented and setting this out in sufficient detail to enable the cabinet to make an informed judgment about whether to proceed in the light of risks and requirements involved. Implementation planning is critical to ensure outcomes are delivered on decisions made by government. Policy reform often involves major transformational change across multiple programs and services and several agencies. Implementing change often requires teams of people with different skill sets to work together across normal functional boundaries within and between departments and agencies. Implementation planning has a strong management focus that requires best practice approaches, skills, and experience to be applied. Effective implementation planning requires a structured approach to thinking and communicating in 7 areas. 1. Planning. 2. Governance. 3. Engaging stakeholders. 4. Managing risk. 5. Monitoring, review, and evaluation. 6. Resource management. And 7. Management strategy. Single purpose approach. According to specialists or single purpose approach, all the following individuals are engaged in financial planning if they use the financial planning process in working with their clients. A stockbroker who advises a customer to buy shares of common stock of a particular company. B, a salesperson who sells to a client shares in a real estate investment trust, REIT. C, a preparer of income tax returns who suggests that a client establish an IRA. D, a banker who opens a trust account for the benefit of a customer's handicapped child. E, a life insurance agent who sells key person life insurance to the owner of a small business. Multi-purpose approach. According to the multi-purpose approach, the following individuals would be engaged in financial planning as long as they use the financial planning process in working with their clients. A multi-line insurance agency who sells all lines of life, health, property, and liability insurance. B, a tax attorney who assists clients with their income, estate, and gift tax planning. C, a life insurance agent who also sells a family of mutual funds to meet both the protection and wealth accumulation needs of clients. Comprehensive approach. A few advisors take a comprehensive approach to providing financial planning services. Comprehensive financial planning considers all aspects of a client's financial position. Such planning includes all the client's financial needs and objectives and utilizes several integrated and coordinated planning strategies for fulfilling those needs and objectives. The 2 key characteristics of comprehensive financial planning are: it encompasses all the personal and financial situations of clients to the extent these can be uncovered, clarified, and addressed through information gathering and counseling, and it employs all the techniques and expertise used in more narrowly focused approaches to solving client financial problems. Role of financial planning advisors. According to consumer surveys, Americans need help in managing their personal finances to achieve their financial goals. A major part of the challenge facing advisors who are doing financial planning is to help clients overcome obstacles by educating them and motivating them to gain control of their own finances. Financial planning umbrella. The major planning areas that follow the general principles of financial planning are: insurance planning and risk management, employee benefits planning, investments planning, income tax planning, retirement planning, estate planning. Now, in the end, let us summarize what we have learned in this lecture. The purpose of financial planning is to help one make the most of the financial resources by setting realistic goals and finding a way to reach them. Financial planning in a business is very essential, as the input and output of a business is totally dependent on the money available. It comprises three principal steps, like estimating and forecasting, preparing a budget, and controlling the outflow of finances. Estate planning is predominantly based in law and property rights. Finding a good lawyer will help one navigate the complexities of the law and help determine the best services for the situation. A financial planner is a professional who helps a person deal with his or her financial issues. A financial planner helps a person in areas such as personal financial planning, investment planning, risk management, and insurance, as also his or her cash flow management.